if it gets to the point where you feel uncomfortable, in all the right ways about the outperformance of a particular stock, and that's the point to say, okay, well, it's been a good run, I should take my profit.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. When we think of trading on the share market, we immediately think of the ASX, the Australian Securities Exchange. But it's not the only game in town. There's another exchange called ChiX, which is a competitor to the ASX. So I'm pleased to welcome the CEO of ChiX, Vic Jokovic. How are you, Vic?
I'm very well, thanks, Phil. Thanks for having me on.
So ChiX Australia is an innovative securities and derivatives exchange aiming to improve and grow the Aussie investment market. It was founded in October 2011 and it's since achieved over 20% market share of daily trades. Is that correct? 20% of daily trades?
Obviously it varies, but we've had days where we've been over 23, 24% of all shares traded in Australia. It averages out somewhere between 18 and 20%.
Yeah, and that's currently executing over $1 billion in cash equities each day.
Each day, yeah. I think the average is actually higher. It's somewhere around $1.5 billion on most days we will execute. So the Australian market, put that into context, is doing somewhere around 6 to 7, of which we do 1.5, and the ASX does the balance.
Yeah. So you grew up in Sydney's inner west. Where did you start thinking about finance as a career?
Look, growing up in a migrant family in Concord, you don't have a lot of exposure to big business. You don't have exposure to shares.
Yeah.
But I suppose my first introduction to shares happened at university. I had a friend at the time at university in my first year there who was already investing in shares, so he introduced me to the concept. And luckily, my first trade was a good trade. That always helps.
Got you in, huh? Yeah.
That gets you in. If you have a couple of first trades that don't go so well, you might shy away from it.
Yeah. And so that piqued your interest. Were you doing finance at uni at the time?
I was. I was doing a Bachelor of Economics degree and law, but I just did the economics degree in the end.
So you worked as a broker in the early days as well, didn't you?
I've worked as a broker. Well, I have worked as a broker really my entire career. So I started in the industry in '85 and really spent 32 of my 35 years working for brokerage firms, in particular Deutsche Bank. I was there. Was Bain and Company. Anyone that's listening will remember Bain as being one of the largest retail broker in the country, going back about 20 years ago, but it was taken over by Deutsche Bank. So I was there for 27 years. So long history in broking.
So tell us about the old days in the trading floor. A lot of listeners to this podcast are very young. I mean, most of the people listening are under 44 years of age, and they think of it as all the numbers on the screen and the tickers on the screen. But it used to be an actual physical exchange, people calling out to each other.
Absolutely. Yeah. And look, there aren't many physical exchanges left. Primarily North America has you can go and see the operation of a physical floor with operators and when in our days they were chalkies, people writing up the prices up on the chalkboards. In those days, so going back to 85, the first interesting thing was the actual broking office itself. Yeah. So you would have 2 to 3 brokers sharing one screen. Computer screens were a new thing. And so we'd have a lazy Susan and one screen with prices. And if a client called up, let's say 3 clients called up at the same time to the 3 brokers, you would be fighting over the screen. So this concept of, a desk now with multiple screens, my desk at work has 4, was certainly not a thing. And then on top of that, you had everyone smoking in those days.
Everyone smoked at work. It was
absolutely. Ashtrays were built into the dealing desks, so it was a completely different environment. And the floor itself was, it's like any stock exchange floor. It's a marketplace. It's where people come together to buy and sell things. So there was a lot of noise, a lot of activity. And, if there was a big, I can recall many instances where you would have a large deal going down. For example, when Homes of Court, this is going to be not well known to the younger listeners, but there was a takeover bid for BHP. One individual and his company at that stage were trying to take over BHP. And the amount of noise and energy that was on the floor at the time, we were handling that trade at the time, and our operator pulled a green bin, emptied the contents, the rubbish out of the green bin, put it in the middle of the trading floor and said, right, anyone that wants to sell their BHP shares for any client of their firm at this particular price, write the number of shares and your broker number, and pop the ticket into the bin. So that was the way the deal was done. So that bin quickly filled with millions and millions of shares traded, but it was all very manual.
So presumably that was in a takeover bid. The buyer is trying to buy a certain number of shares in that company, and these days it's all done on the screen. But in those days, it was like that. It was physical chits and open outcry, and you had to be heard, and you had to tell them what you were doing, and it was all written on paper, and it was all processed after that. How long did that process take to get up to it 15% that he would need?
The 87 crash, and I was a young broker at BZW. Me is one of the big retail and institutional brokers at the time. The 87 crash, October 87, exposed just how manual and how broken the process was, because mountains and mountains of scrip, you had your shares were held on basically a piece of paper mounted up in the offices of the brokers. And even from the events of October 87, those trades were not settled and dealt with for months. In some cases, they were never processed. So that's how manual it was. Yeah.
That's amazing. So what is an exchange?
Well, an exchange is simply a meeting place in the same way as it's a market. It's a market for shares as opposed to a market for fruit. Or for any other goods. So think of in Sydney's Flemington markets. It's a meeting place where people come in and buy their goods. In the case of a stock market or an exchange, the ASX and ChiX are where buyers and sellers come together to exchange shares over corporate names and over other instruments as well.
Wow, that's a golden explanation. I love that Flemington market explanation of that. In another interview, I heard you talking about the competition between ChiX and the ASX, and you made the comparison between Aldi and Woolies. Is that kind of how the competition is working between the two exchanges?
Yeah, look...
a new upstart?
Well, absolutely. For the last... and this was the case in almost every major economy and every market across the globe. You've had one exchange for hundreds of years. In Australia, you had you've had the Australian Stock Exchange in different guises. There was Sydney Exchange and Melbourne Exchange. There's a whole lot of regional exchanges. They came together to form one Australian exchange.
Yep.
And for the last 150 odd years, there's been no real competition to that one exchange. And ChiX, as you said, came in 2011. And for the first time, you had competition in exchange services. And, I mean, everyone knows that competition is a good thing. The incumbent may not like it. The ASX may not like it. Woolworths and Coles may not like Aldi coming into the market. But for the consumer, it's a good thing because, it brings tension into pricing. And that's what's happened. I mean, we maintain a good relationship with the ASX, but we also butt heads. They are our competitor, but we also work with them on certain things. They are the Australian clearing and settlement facility. So we have to work with them, but we also compete with them.
So a retail investor, where would they see the name ChiX coming up? I mean, I know sometimes when I've made trades on CommSec, for example, you can see some of the trades are with ASX and some are with ChiX. Is that the kind of place where it appears? It's pretty seamless, isn't it?
It's very seamless. So when any of your listeners, when anyone buys shares, you'll get a confirmation from your broker that you've either bought or sold those shares, and you won't necessarily know where those shares, on what exchange those shares were purchased. In the case of, you mentioned CommSec, for example, CommSec actually send all of their trades or route all their trades to ChiX ahead of the ASX, but only if the price, there has to be the equivalent price. And if there is equivalent price, then it'll route to us first, but others will go to the ASX first. But for an investor, they won't know in most cases where they bought the shares. And for example, today, if you go and buy 10,000 Telstra shares, there's a probability that 30-40% of those Telstra will be bought on ChiX and the rest on the ASX, but the end buyer won't know. So it's very, very seamless.
So ChiX has provided competition on price. Where does that price show up in the process?
So the pricing, ChiX came into the market, and as a disruptor, clearly, and you used Aldi as an example, and there has to be some benefit. If we came into the market and charged the brokers the same amount to trade on our exchange as the ASX, then it'd be a whole lot more difficult to get any buy-in. So really, the process is that you as the investor put your trade on through your broker, and now if that broker can execute at cheaper prices on ChiX versus the ASX, buy the same shares, buy the same BHP, Rio, all the same shares that you're buying on the ASX, you're buying on ChiX, but the broker himself is paying a lower fee. And by lower, our fees to those brokers have been as much as 70-80% lower than the ASX. That's partly because the ASX has had a monopoly business for 150 odd years, and so there was no pricing tension there. And so we've introduced that. And by the way, the ASX has responded and said, okay, ChiX has dropped their fees, we better drop our fees as well. And so ultimately then the brokers, if you think about what brokers charge these days, you can trade through CommSec or these other online accounts for not a lot, for really cheap commission fees. If you go back to 20 years ago when there was no competition in exchange services, 2 to 3% was a normal commission rate. I was charging, as a young broker, retail clients 2% back in the 80s and 90s. So that's, you think about that, and with a minimum order cost of $100 or $150. So if you were buying $500 worth of shares, you were paying $100 in commission. You were paying 20% away straight away. That world has changed, and that's really been facilitated by the competition in exchanges. Between 2011, ChiX coming into the market, and today, a saving to the broking community of somewhere around $200 to $250 million has been passed on by lower exchange fees, and therefore those are passed on to the end user through lower commissions.
So we've got you to thank for that.
You've got competition to thank for that.
That's a great thing. So you actually issue various kinds of products on the exchange, like warrants. As an example. Can you explain to the listeners, especially for beginners who've never heard of a warrant, how they operate? So warrants are essentially an instrument that allows you to take a position in an underlying share or underlying corporate without paying the full amount for the share. So it's a contract like an option, essentially, to be able to buy those shares, but with some leverage. So they will have, to try and keep it simple, they'll have a strike price if the shares are trading at $2 and they're a $2.20 strike, then clearly, unless those shares go above $2.20, they have no value. But it allows you to use some leverage to buy shares. And there are warrants over many, many instruments and many corporate names in Australia. And
the best way to learn about warrants is to start with the guide, the warrant guide.
Which, if you want to trade, you actually have to get permission to.
Absolutely,
you can't just do
absolutely,
it.
Because they are not complicated, but they are a level more complicated than simply investing in underlying shares. And you've got to understand that when you buy a warrant, if the share price goes up, and there's also an expiry period. So it's got to do that within the expiry period. So there's a slight level more of complexity, but they are generally a fairly, they're not a difficult instrument to understand, but you need to take the time to read the guides.
Okay, let's talk about traces, because this is the really exciting product as far as some of our listeners would be concerned with. So you can actually, with traces, and if you can explain what traces stands for,
sure,
you can get direct exposure to overseas, direct investing in shares overseas.
That's right. So Australians have always had interest in buying international shares, but the proportion of users is still very low. And part of that, and when I say low, I think within Australian super funds, less than 1% is held in direct shares in Australian super funds. So it tells you it's a very small proportion. Now, part of that is that Australians have been very Australian-centric in the way they've invested. Property, Australian shares, it's been
the banks, BHP, Rio,
exactly,
standards.
The standards. And, so much so that, 50-60% of our Australian equities market are the banks and the miners, essentially, and maybe healthcare takes it to 60%, with a very small proportion in things like technology. So part of the issue then with buying shares directly is in the past it's been difficult. You have to set up an international account. You've got to set up a custody account. You've got to sign all sorts of.
There's a lot of legal documents, isn't there, if you want to buy
legal documents, W8 Ben forms. I mean, the list goes on. So it's not straightforward. Then on top of that, commissions have been elevated on international trading in international shares. I'll expand on that. And you've also had large, heavy FX charges because there needs to be an FX conversion, and you're taking your Australian...
the foreign exchange,
foreign exchange. Foreign exchange. You're taking your Aussie dollars and you're buying some US shares. They need to be converted into US.
And there's a fee for that.
There's generally a big fee. And this is where I caution people, number one, for people investing, people that are new to the market, don't ever believe if you see an advertisement for free commission, and I'm agnostic, I work at an exchange, but I'm just saying that, and I've told this to my children, there's no such thing as free commission. There may very well be no charge for the actual commission to buy those international shares, but all the fees will be wrapped up in something else. And generally that's the foreign exchange fee. And that can be heavy. That can be 1% or more. So you buy $100 of shares, you've already lost or given away $1 just for the FX conversion. And then when you come back out again, you lose another $1. So you've lost $2 on your investment. So the thing about traces, this product that we've brought to the Australian market...
And what's that stand for?
Transferable custody receipts. They are a product that has been around for a long time, but only new to Australia because we only brought it in about a year and a half ago. Americans buy nearly all of their international shares via something called an ADR, an American Depository Receipt. And they are essentially what a tracer is here. So for the last 100 years, Americans have been buying their American individuals, American investors have been buying their Australian shares and their German shares and their international shares via ADRs. So it's trillions of dollars in the US. Yet in Australia, we've never had this product. So what we did was we sort of re-engineered that concept. We joined up with Deutsche Bank, who are a global leader. They actually are the global leader in those ADR products across the globe, and we issued these in Australia. And we started back about a year ago with just Apple. So this means that you can go to your Aussie broker, you can go to CommSec online, and you can buy an Apple share during the day in Australia, denominated in Aussie dollars, with the FX charge being a wholesale rate. It's like 1/100th of a dollar, a cent, let's say, a bip. And so the FX charge is very small.
Yep.
So it's a much more efficient way to buy those Apple shares than doing it through an international account. Now, that's not taking away if you feel that you don't mind the process of buying shares through an international broker and the rest of it, fine. But if you want ease of access, the fact that you don't have to go and fill out forms, you can call your broker up today and buy now, as we've progressed over the last year, 35 of the big US names that I'm sure everyone listening will be familiar with, from Starbucks to Walmart, Microsoft. Think of any large US company, McDonald's, and even of late we've added some COVID, coronavirus related names that have benefited from it, like Gilead. Gilead's an interesting one because they're the US pharma or health company that most people believe may get there first with a vaccine. They've been involved in producing vaccines for things like Ebola, for the SARS virus and other things. And then even a company like Zoom. The world is now working increasingly from home and using Zoom. I do 4 or 5 Zoom conferences a day, and you can buy Zoom shares. And all these shares have obviously gone up a lot. That's not to say they're not going to continue to go up. We'll see where the world goes with COVID. But now you've got access to these 35 names through this ADR style structure via the traces, and it's seamless. You call your broker, they send the order. In this case, it doesn't go to both the ASX and ChiX. It's because they don't trade on.
It's a ChiX only.
It's
product.
a ChiX only product. It's ChiX unique.
Yep.
And we've seen a reasonable uptake. We've had trading in all 35 names. Some a lot. Berkshire Hathaway, the big US fund manager, has been the most popular.
Is that the big one or the little?
The little one.
The little one. Yeah. You can't afford the big one.
That's right.
It's hard.
Well, so it's access to. Through those 35 names, you've actually got access to about close to half of the US index by market cap, by value.
Yep.
Because you think about some of these big names that we don't have access to in Australia, like Microsoft and Apple. These companies are bigger on their own than the entire Australian stock market. Yeah.
In terms of accessing these, it's like buying any regular stock. Is that correct?
It's seamless. It's exactly
so
the
you
same.
can go to CommSec or any of the other providers and buy one of these and the codes.
Yes.
Okay, we should put a link in the show notes as well to explain how people can access these and what the codes are, because it's a concept I've never heard of until I've met your people from ChiX before, and it's an exciting way to get involved in the US market, isn't it?
Absolutely, Phil. It's innovative. Australians, we think we're not conservative, but what I've learned over more than 30 years in markets is Australian investors tend to be fairly conservative in the way they think about new products. I think the uptake is quicker in markets like the US. But so it's a new product, but it's something that's been around for 100 years, and it's very straightforward. One tracer equals one share in whatever you buy, and your dividends come to you in Aussie dollars. Your broker doesn't need to reset you up. And importantly, one of the key features is they sit on your HIN, your holder identification number. They're identical to any other shares. So it's not like you're going to have different reporting. Your broker will be able to give that all to you in one report.
You spoke before about chatting with your kids about investing. What's some of the dad advice that you give them?
Well, I mean, I've had, there's been a lot of interest. So I have 3 children. Mm-hmm. They're all at university at the moment, so they're not exactly cashed up.
Right.
They're still relying on the bank of mum and dad. But, you know, they've been working and they've got some savings. And my middle daughter and my son are both interested in buying shares. And when the market came off in March, you know, we were talking about whether they should or shouldn't invest. We were looking at some traces. We've had one investment in a tracer already from the kids.
Yep.
But the way the market kicked back up, my advice to them has been to be patient and to be cautious. And I've been in the press of late saying that what we have noticed is a massive uptick in the amount of day traders in the market. Now, as an exchange, we love volatility and we love activity. And we love the heightened volumes. That's good for us. But I also caution everyone listening that, you know, day trading it's not always a positive experience. So a short-term investment should always be considered to be longer than a few days or a week. You know, short-term investment, in my mind, is a 3 or 6 month bet, and a long-term bet is, you know, let's keep it in a super fund for years.
Yep.
And generally, when you do that, you make money if you've got quality names in there. Generally, these things, if you pick the right names, you know, at the quality end of the market, then you will do well. But you may not if you're expected to go up within a week or two. So be patient and also be cautious in the way you invest.
Because that's something I counsel listeners all the time. I've got a Facebook group and people start coming in and going, what do you think of XYZ share? And I always say, well, first of all, we're not giving any financial advice, but having seen the demographic of the listeners to this podcast, all I can say is that they've got time on their side, and that's the greatest investment tool, isn't it?
Absolutely. There is no rush. There will be, you know, if you look at charts, there will be buying opportunities. There will be selling opportunities. We see some of the same panic in other investment products. You know, let's talk about property at the moment. Do you buy it? Do you sell it? You know, these things are cyclical.
Yep.
And there will be opportunities. And the nice thing about the share market is it's far less uniform than the property market. Property markets in places like Sydney tend to be uniform. You know, it goes up and everything goes up. A house in Balmain goes up, it's more than likely that houses in Crow's Nest are going up. In the share market, what we've seen...
It's lumpier, isn't it?
It's much lumpier. And actually the dispersion, the difference in performance in sectors through this COVID crisis has been different to almost anything I've ever seen before. So if you go back to the GFC, and in my case, if you go back all the way to the crash of 87, the market was much more uniform in the way it reacted in 87, in other crises like 2001, 2007. It tended to either, you know, in a uniform way go down in those instances. What we're seeing here is massive dispersion between sectors like technology, up significantly, healthcare, pharmaceuticals, up significantly. Travel down significantly, REITs, property related names down, banks down. So when you look at the market, it's incredible the amount of outperformance in some of those sectors and underperformance in others. So there are going to be opportunities. There are probably going to be opportunities with those sectors that have underperformed as well. And another interesting point around that is that because our market has so little, the Australian market has so little in the way of technology names, you know, when you compare it with the US market, for example, you need to be very careful. The S&P 500 has a large proportion of these technology names driving it.
It's huge, isn't it?
Yeah.
It's absolutely, I can't remember the figure, but it's a huge percentage,
massive,
isn't it?
Yeah. And versus our market that's, you know, down in the single percentages being driven by these tech names. And so trying to draw some sort of parallel, well, the US market is up and we're down is probably not the right way to think about it. Think about what drives our market. And we said earlier in this talk that the Australian market has a large composition of banks, in particular, and miners. Well, the banks are dragging our market down because they've been underperformers. Whereas in the US, the tech names are dragging the market up.
What about with your kids? Have you ever had the experience, I've heard this, some of their parents get them started in the share market, and the kids after 6 months, a year, see a capital gain, and then they think, I'm going to buy a car or something like that. Have you had that, come across that experience?
Well, I mean, I have, and I don't think that kids are any different now than they were than I was as a kid. Or
there's always some golden shiny object that you want to buy.
There was an object you wanted to buy. I mean, this concept of long-term investment doesn't sit well with a 20 or 25-year-old because, I mean, there's other things that they need, and you're just setting up in life, and in your 30s you're trying to buy, or late 20s you might be trying to buy a home. So selling shares is probably an avenue for that. But again, that's not to say that you can't come back to it, but I don't think it's any different now than it was before. There'd
be a difference between selling to buy, say, a car than to selling to put a deposit on a home.
Absolutely.
There's a big difference between those two.
There's a big difference between that. But if there's a need, then I'm sure that they'll sell what needs to be sold. But what I would again advise is, if you can possibly hold on to those shares, and again a quality portfolio, something that you're comfortable with. You talk about some of those big brand names. Over the long term, you're going to do well. You will do well, particularly if it's spread across a number of names, because those outperformers would, if they're quality names, would generally more than pay back any one or two of those names that may not do so well.
You've got a lot of experience as a broker and with clients. What's the worst mistake that either you've made or you've seen someone else make in terms of losing money? And what's the learning that's come from that?
Most professional investors and traders that I've dealt with, and I've dealt with many fund managers and I've worked with many traders over the years, there'll always be one thing that they come back to, and that is, taking their profits too soon, not letting a winning stock continue to do what it's doing, or a stock that's performing well, just getting out too early. And then on the flip side of that, have in mind a stop loss, a point at which, a share that you may have bought that's gone sour. Actually making a call on getting out of that stock can be difficult.
Yeah, know when to throw in the towel.
Know when to throw in the towel, and every trader across the globe will uniformly say the same thing. And if you're disciplined, and you set your boundaries, you'll generally do pretty well.
Now, it's interesting you say about letting your winners run, because presumably if you've done the correct research and you found a stock that is performing and has got many reasons to keep on performing, why would you sell it anyway?
Absolutely. I mean, if that changes, and again, we're not here to give advice, and I'm not here to give advice as well, but in terms of actual shares to go and buy. But, there are names that, if it gets to the point where you feel uncomfortable, in all the right ways about the outperformance of a particular stock, and that's the point to say, okay, well, it's been a good run, I should take my profits. There's nothing wrong with taking profits if you're feeling uncomfortable about the amount that an underlying share has run, or about some change in the fundamentals of that stock. Again, COVID has shown us, the blue chip investment in the banks, it's always been seen as, pretty bulletproof, but things can change and change quickly, and the banks will not have an easy time of it through this crisis.
Yep, and they haven't had an easy time. The price action's been terrible for the banks for years now, really.
Yeah, and that's the point. There were themes, there were stocks that were under pressure prior to COVID for all the right reasons. That the COVID issue has just accelerated generated a reason not to be in those names.
Vic Jokovic, thank you very much for joining us on Shares for Beginners.
Pleasure, Phil. Thanks.
The company and or guest has contributed to the costs associated with producing this episode of Shares for Beginners. ChiX is the holder of an Australian markets licence to operate a financial market in Australia. Any information is provided for informational purposes only. It's not intended to be financial product advice. Under no circumstances is it to be used as a basis for or considered as an offer to engage in any activity or purchase or sell any security, or as a solicitation or recommendation of the purchase, sale or offer to purchase or sell any security. To the extent permitted by law, ChiX makes no representations or warranties and excludes all liability in relation to the information provided. Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances or current situation. Thanks to Christopher Soulos for music production with that special Greekalicious flavour. Remember, music always flows, even when the money won't.